I'm going to talk to you today about Ethereum options markets. We're going to talk about these in two segments. We're going to think about them through bilateral trading, as in over-the-counter trading, or also via an exchange. And we're also going to talk about it as in concepts for decentralized finance and how options markets and structured products are going to start trading, or even more significantly, going to start trading in decentralized venues. I'll start by, why are we talking about Ethereum options? Number one, before I get to the bullet points, Ethereum is going to be, and already is, becoming a balance sheet asset for a number of entities, corporations, obviously hedge funds, and of course our Ethereum whales that are already invested in the assets. So if like Bitcoin, Ethereum is going to become a balance sheet asset, treasury managers need to be able to manage the risk between ETH and dollars, or the ETH dollar spread. Also, as we're all aware of in this room, Ethereum is a global settlement layer. Okay, so they're perfect for clearing options transactions. Options are risk transfer mechanisms, and we're going to put them to work to defend our Ethereum position. I'll show you how we do that. As I already said, decentralized options exchanges are gaining momentum, and the next iteration of that will be not just vanilla options, but structured products and exotic options. And this is where it gets very exciting for traditional finance that's going to start using Ethereum rails. I wrote a book on Bitcoin options. Obviously, we're at ETH Denver. The same strategies apply. This book is available on Amazon for anyone who wants to learn more about how to manage risk or generate real yield. And I have 2 copies with me right now. So if anyone's extra interested after the presentation, come find me and I'll give you a copy of the book. So here's what we're going to talk about. We're going to talk about statistical arbitrage. We're going to talk about covered calls, zero cost collars, cash secured puts, and risk reversals. So this is the market I'm going to show you guys. It's going to be the March 28th Ethereum options market. I took this screenshot on Friday when I put together the slides. Ethereum was trading at 26.55. The futures price, the forward contract for March, was trading at 26.76. The days to expiration for these futures and options is 34 days when I took the screenshot on Friday. And volatility is at 63%. And the spot, notice this. Notice the spot price of Ethereum and notice the forward price. You see how the spot price trades under forward? There's a 9.4% annualized rate of return for anyone who's interested in that spread. And that's where I'm going to start the presentation. This is statistical arbitrage. The blue line, as you can see on the screen, is spot. And the green line is the forward price. I can go ahead and buy spot Ethereum and sell forward, sell the March 28th futures contract, and annualized 9.4%. Now, this is with Ethereum or Ether going through a little bit of a rough patch, as we all realize. This spread is usually much bigger than 9.4%. When Ethereum gets into a bull market, this spread can blow out to 20-25%. So astute traders and portfolio managers and treasury managers can buy spot Ethereum, sell forward, and lock in that spread as a P&L gain for their portfolio or for their treasury. So we call that the basis trade. There's some other things you can do. And this bottom right square, I say, you can either collect that spread as yield, 9.4%, put it in your pocket, or you can buy spot Ether, sell forward, take that spread, and buy call options. And now if Ether rallies, you're going to have a gain that's significantly greater than 9.4% from the call option. You can also do call spreads or buy binary call options. Again, if you're into this stuff, come talk to me. I'll leave it at that. So that's the basis trade. That's buying spot Ether, selling forward. Now I'm going to talk to you about options. There's 2 types of vanilla options. There's call options and put options. A call option grants the holder the right to own the asset Ethereum at the strike price on the expiration date. The expiration date I'm going to talk about is March 28th, which is the last Friday of this coming month. Put options are the opposite. Put options allow the holder of the contract the right to sell Ethereum at the strike price on the expiration date. Now, I'll try to make some sense of that for you all, but first, Ethereum options contracts are 1 ETH. One contract represents 1 Ethereum, 1 ETH. The expiration dates are weekly, monthly, or quarterly. They expire on the Fridays at 8 a.m. UTC. The strike price is the price which a transaction will occur if the option is in the money. It's either a call or a put, and the settlement is either Ethereum or US dollar / stablecoin.